part of this game is surviving that game, is surviving until your strategy works, until you can see those string of winners. And that's something that a lot of people don't realize is while you're learning, especially, that's extremely important, is just to survive.
This is the How to Trade Stocks and Options podcast, brought to you by 10MinuteStockTrader.com, where we cover finance, stocks, options, entrepreneurship, education, and money. And here's your host, voted one of the top 100 people in finance, Christopher Uhl. Today's episode is produced in partnership with FinClub.ai. Trade with confidence and leverage the power of artificial intelligence in your trading starting today. Go to FinClub.ai to get 2 free weeks of AI stock picks and save 15% when you use the code SAVE15. That's at FinClub.ai. Hey, make sure you subscribe and hit the bell so you'll be notified every time we give you more tools, tips, and tricks to help you trade faster and trade smarter every single week. Hey there, traders. Welcome back to today's podcast. Today we have a special guest online, Matthew Timpane. He is the senior market strategist at Schaeffer's Investment Research and a super smart guy. I'm really excited to have him on today and to learn from him. Matt, thank you so much for coming on.
Thanks for having me on, Chris.
Yeah, no problem, man. It's a crazy world out there right now. I mean, we here in Texas have been opening the doors with the virus, and we're in July now. And I was just telling Matt before the show started, things are they're absolutely crazy. And one of the things that's just blowing my mind is in Texas, we had about 700 cases a day of the virus in March or so, and we were on total lockdown. Everything was just shut down. Nobody's going anywhere. Now we're in July. Six Flags is open. All the restaurants and bars and everything else are open. And now we're seeing about 8,000 cases a day. So, 10 to 20 times as much as it was a few months ago when they shut the whole world down here. And now we're open for business. So I don't know what's going on out there, Matt. Tell me what's the deal, man? What are we going to do?
Well, I mean, I think it's overall, it's probably a pretty complex and tough decision. Obviously, there's two factors. You want to focus on life, and you want to focus on also not destroying the economy is one factor. So is another factor. So I guess what they're looking at is they're trying to thread a needle. It's obviously not working well. We're seeing surges going on. We do see the new mask requirement, like you do have out in Texas and in California, and hopefully that will help spread or help decrease the spread of the virus. I'm not a virologist at all, but I think we know that does work a little bit. I know where we are, we're seeing surging as well. There is more restrictions on things. Some restaurants are being closed if they are known to have been spreading any of the virus or anything like that. As we're talking about, like you said, Six Flags were open. We have some theme parks open, but they're running more at a limited capacity and on a reservation basis. So I think, taking the appropriate measures while maintaining the economy as you can is probably the right way to go about it. But fully reopening is probably a very difficult thing to do right about now. And it's something that you got to think about not only your community.
It's a crazy world out there right now. So what are you guys doing over at Schaeffer's Investment Research to try and work around this?
So some of the things what we're doing is we have been working from home for the most part since the beginning of March. A lot of us started going home at the end of February, but I made it to the beginning of March. So we've been trading from home, doing our work from home. As you can see, I'm at home right now. We did start going into the office a little bit here in June when the governor issued you could open back up. But we're doing it on a very controlled, limited basis. Not everybody's in on the same day. When we're in, we're wearing masks. We're trying to do that just so that we have some people on the floor. It does help for communication purposes as a business. But we also respect and want to make sure that everybody at our company is safe. So that's one of the big factors. So, everything is done up to highest standards. We have cleaning materials all over the place. You're required to wear the masks in the building. you're trying to do the best things you can. But we're also trying to put out great content and capitalize on opportunities during these market environments. Something that we've been able to actually do fairly successfully during this volatile periods of time on the downside and upside. So it's been an interesting time, and it's also been some interesting content that we've been able to put out there.
Yeah, absolutely. And on that market volatility, man, this has been, 2020 is going to be one of those years where people just want to forget about it. And I know so many people when it was late February or so, everything was just falling apart. So many people are like, all right, I'm getting out of the stock market, never going to do anything about it again. Little did I know, like 2 months later, it would be at that point or greater, right?
Yeah.
Yeah, like the Nasdaq setting new all-time highs, gold setting new highs, and it's like, who would have thought? We have this global pandemic going on, literally outside, and we're setting new highs. It's crazy to think about.
I don't think anybody really thought that. I think a lot of people thought we were going to be on more of an L shape or a U shape type of recovery, and we could still be more on that U shaped recovery within the economy. I think a lot of people didn't realize how fast the Fed would act by providing liquidity to the markets. So I think that was something that kind of caught people off basis, where Jerome Powell's, he was an operator and an investor his whole life, in private equity with the Carlyle Group, his own private equity funds, things like that previously. So they acted quickly so that they didn't see another crisis. So I think that easy money obviously helped prop up the markets, and prevent further deterioration, and it eased people's concerns. So the market and the economy have definitely, I would view at this point in time, have decoupled. A lot of times they are in lockstep. You need to know that they are different, though. That's the one thing a lot of people kind of get wrong, is they're not the same. One's forward-looking, one's currently what's happening most of the time. But they, at this point in time, there is decoupling. We've seen it before in other recessions as well, and I just think that's kind of where we are now. We could still have more volatile bouts going ahead. Definitely don't deny that with all the uncertainty. But that's a factor as a trader that you need to realize. Sometimes you may think everything's going horribly in the economy, and things could be quite different in the market itself.
Yeah, without a doubt. I certainly never expected it to be this fast of a stock market recovery, at least. But I could see there's a lot of. I was just talking to my parents the other day. They're 70-ish, and I certainly wouldn't want to give them the virus, because they would definitely be the first ones to go for sure. But talking to them, it's crazy to think where we are, and they've never seen anything like this in their lifetime. Mm-hmm. But also, like, there's going to be ripple effects that we don't even know what they are yet, like movie theaters. The one that I'm very concerned about, if I knew how to be short corporate real estate, I would be short commercial real estate, I should say.
Yeah.
Because you've got so many people that you just trained for multiple months to be proficient to work from home. They don't want to go back. They don't want to sit in traffic. They don't want to sit and sit in an office when they could sit in their pajamas, right? Yes. At home doing all their work, and they've already proven they can do it. I can absolutely see commercial real estate tanking, because now you had a company that could house, or you had a building that could house 500 people. 400 people that work there don't want to go back, and they've proven they don't have to. So they're going to put up a fight to say, I can work from home. I want to stay home. And then you're going to say, well, we don't need a building for 500 people. We need to downsize. So now all these skyscrapers and everything else, I could really, really see the commercial real estate field being just upended. I don't think so much on consumer real estate, like homes, apartments, things like that. But commercial real estate, I think, is going to implode. That has me a little concerned, because what are the ripple effects of that?
Yeah, and I think you're exactly right, that there is definitely concern in areas like that. We are going to see some changes. I think people want to get back to a sense of normalcy at some point in the future, obviously. So not everything will change as dramatically as people think, but I also think that like you said, people have been taught new habits. They're able to change some things. I think the office is one of them. More remote work will definitely happen. You're seeing that with companies coming out, Twitter, Facebook, multiple Silicon Valley companies offering work from home permanently, basically, changes. But that would be a good one. I think commercial real estate will struggle probably next, obviously 5-10 years. Eventually it'll be repurposed or grown back into as we grow as an economy, as a population. But that will take time, and you're probably exactly right. The other thing is, you're right. People are enjoying not working. We're working from home now, not having to travel. It saves money, actually, in the long run. That's one huge factor I noticed is, you spend less money on gas, less money on food, less money on just the various factors because you're not out and about anymore. So that's something I definitely agree with there. And I think you'll see, and that's what you're kind of seeing with this bifurcation, I guess, within the market, where you're seeing some of the regular stocks that have gotten absolutely crushed. Yes, they've rebounded, nicely kind of after the fact, but you saw a lot of these new kind of age companies bottom first and then rally, and they're the leaders of the market right now. Because you're seeing this change within the workforce, and people are trying to obviously get in front of that with a lot of the companies, obviously Zoom Media, Teladoc for telehealth, Slack even had a huge bounce there. They're a little bit struggling now, but you're looking at these companies and you're seeing them move in that direction extremely fast, and that's because the age is going to change and people's habits have changed, and going forward, the way we are as a society, there will be permanent changes. I do think another factor that, one thing, like you said, commercial real estate's scary. I think from a personal perspective or a society perspective or a community perspective, and I'm not sure how to exactly you would play this in the market other than maybe through like telehealth type stocks. As mental health, I think will have a huge effect. Going forward, this will have had an effect on that. So that's something I just think about from a personal standpoint, from a family standpoint as well. How this affects people. You're kind of locking them into their houses, or at least having them stay in a lot more. They're not used to that. People are obviously social animals to some extent. So there's other factors as well within society.
Yeah, for sure. So the real reason I had Matt come on was to talk about some options trading mistakes. But we got to talking ahead of time before the episode, and I was like, hold on, we gotta put this on hold. Let me go turn on everything to start recording, and we can finish this conversation. So yeah, so Matt, tell me about some of the options trading mistakes that you're seeing out there, right? Now, it may not be something that you've experienced personally, but you've probably come across some of these along the way that you've seen somebody make a mistake. I've personally had plenty of mistakes. I've had a whole episode on all the mistakes I've made, and I've blown up my account twice before I figured things out. So I don't want to do it a third time. It would be a lot rougher to do it a third time.
Well, that's one of the things. So one of the big things that we'll focus on common mistakes that we see option traders make. I have a plethora of them all, but something that we'll focus on. I was previously a partner and portfolio manager at a registered investment advisory firm before I joined Schaeffer's. And one of the things that I've noticed since being, more into the options market and trading and advising and research here is we don't talk about allocation all that much in options. You hear about the trade strategy, the big winners, how they got that, the edges, and I have all that as well, but you don't hear about risk management and allocation strategies and practices that you should be following as part of your plan when you're trading options. So one of the big things we kind of look at Schaeffer's, and we don't recommend, we recommend to people is, really your allocation to options should be, no larger than 30% of your portfolio. That's the largest it should be. And then if you are going that large, really the rest of your capital should be in like riskless or near riskless assets, because, one of the biggest things is you don't want to ever have all your capital at risk at one time. Now, many people we obviously know want to stock trade as well. So what we would suggest then is that you just reduce your option exposure as well if you're going to stock trade with it. So you can bring that down to 20 or even 10% if you needed to, because what you're looking for is in your options trading is that leverage. And so, again, the factor is you don't want to have all that capital at risk because you don't want to have scared money out there. When you do have scared money or you're looking at potential huge losses in capital that you can't afford to lose. You don't want to be without your retirement money. You don't want to be without money for food and other things like that. You typically make bad decisions is one of the big factors, and we don't want to option traders to be put into financial burdens. Like you said, you can blow up an account very easily. It's happened twice to you. It's happened to all of us. So, anybody that's been trading options at some point is probably likely blown up at least a small account at some point, just because of some different things that they did wrong. And that's one thing. Hopefully, we can get through some of these risks here and help some of these options traders so that they don't have to go through some of the pitfalls that we did.
Yeah, I like to tell people they can learn from my expensive lessons for free.
Yes. So,
I was just going to say, my experience with that is just being too aggressive and really not having an exit strategy. And right now may not be a great time to be aggressive considering market volatility and really a lot of uncertainty that we were just discussing earlier. But yeah, that was where I went is, I'm buying twice as many long calls as I probably should have. And then, none of them go in the money. And then, options are so much different than stock. With stock, you still have some equity value. With options, you could literally have zero, which is what happened to me.
Exactly. So some of that is we're looking at options are obviously it's a truncated risk, right? So you're limiting your losses to obviously your full premium that you pay, but you have unlimited theoretical potential to the upside. But obviously there's still risk, and one of the ways that we kind of look at is you want to diversify. So not only diversify, like you're saying your calls, you had too many long calls. You want to diversify through sectors, through types of trades. So not only through, you want to kind of look at how many in the money trades that you've placed, how many out of the money trades that you've placed. And then you want to look at your call put ratio, and that should really vary as well on an overall market view. So no matter what, we think that you should probably have some calls and puts. Things can turn at any moment, and it's a way to kind of de-risk that leverage trade a little bit for you. So that's one factor when you're looking at it from an overall portfolio perspective. I think you should be looking at is the way that you diversify. Again, through sectors, types of trades. That means shorter term expiration trades to longer term expiration trades. So in the money to out of the money, and the way that you have your call put ratio is kind of determined on your overall market view.
Yeah, that makes a lot of sense. So let me ask you a question real quick. What's one thing you wish that you knew before you started trading?
So one thing that I wish I knew before I started trading is actually diversify. So one of the big things, so we just kind of talked about it, and the reason why I say diversification is I, as a young trader, ran into concentration risk. And you see all these great traders out there. Obviously you have highly concentrated traders like Bill Ackman that everybody hears about, and you can also see his pitfalls, his downfalls, and his upswings as well, where he's had huge winners, huge losses. But he can take that risk. When you're starting out, you can't take that concentration risk as much. You need to start building basically your base for trading capital. So that's one thing I kind of wish I knew that I didn't understand, I guess, right when I first got into trading as well. I thought, hey, I know what I'm doing. I can get, hit this money, or hit my targets, get to building this bigger surplus of capital to trade from so that I can be a multimillionaire one day, in a few years. And that's just not the way it works. You need to kind of diversify while you build that base, have your money to the side that you need to keep. You should always still be keeping, like a good portion of your money, maybe just in the general market, and just let that thing ride out on the side. Keep that away from your trading capital. because you want to have the diversification, because otherwise, like you said, you can blow up your account, you have nothing left at the end of it. You have no money to play going forward. And part of this game is surviving that game, is surviving until your strategy works, until you can see those string of winners. And that's something that a lot of people don't realize is while you're learning, especially, that's extremely important, is just to survive.
Yeah, I couldn't agree more. For me, I've got several portfolios that I manage, and my main one that I do a lot of work in, I keep 75% as like an investment group, and then 25% as a trading group is how I look at it. So I have investment class securities and then trading class securities for me. And for me, the trading class is basically call and put spreads, options generating income spreads, right? With the thought of, hey, listen, I understand that there's a 3-1, 4-1, 5-1 risk return here. So if I'm going to make $100 on a trade, I'm not going to let a loser turn into a $400 loser on that trade. I'm going to cut the losses early. Because that was another thing that I mean, the first time I blew up my account was being, too long calls, right? The second time I blew it up was I started using spreads, but I didn't manage the risk of the spreads. So my return of 1R would have a 10R or 4R, 5R risk, and I would just let that happen. And that's a real quick way to blow up your account. So for me, I only look at about 10 different things for trading, and only the most liquid securities. But on my investment portfolio, I really only look at a handful of things. And that I got this from the All Weather Portfolio by Ray Dalio.
Okay.
I don't know if you're familiar with it, but
yeah,
it's like 30% stocks, 40% long bonds, 15% short bonds, 7.5% commodities, and 7.5% gold. If you didn't write that down, rewind this 30 seconds, write that down. You're going to want to use that. That's something that I use whenever I'm investing. And I take that one step further. So because you hear a lot about people just like holding forever, right? Their investments are going to hold forever. But why would you hold it forever if it's below the 50-day moving average? Why would you hold it forever if it's below the 200-day moving average? That's not a strong stock. That's not a place to be. So I took the all-weather portfolio one step further, and I back tested it on a bunch of different moving averages, and I found like the SPY, right? If it's above the 10-day moving average, I want to be in. It's a great place to be. If it's below, I don't want to be in it, and that's okay. I can just put it in cash otherwise.
Yep.
So that's how I manage my investment portfolio, is those allocations, and then I have different moving averages that I use as like my green light or red light. And then if it's a red light, I just put it in cash. So that's how I do it.
No, and I fully get that. Actually, that leads into not exactly onto the allocation, but a common mistake that I also see is a mistake, that people make, a failure of understanding the link between the win rate and the average win and the average loss, right? So, some of the best traders, obviously, in the world, their average win rate is only roughly 50%. But what they're doing is they're cutting their losses quickly, like you said, and letting their winners ride. The one problem that we have when we're trading options is we have a couple of headwinds that come our way when we're doing this. First, when you're a stock trader, you have essentially unlimited time for it to work out for you if you wanted to, right? For that to become a winner. Whereas in an option, you have a limited time, a window of opportunity for that trade to be right. Secondly, we have obviously time decay working against us in options on that trying to be right. And as you approach expiration, in a non-linear fashion, it decays. So the closer you're getting to expiration, the faster it starts decaying. So there is multiple factors there that kind of you have to learn, especially in options trading, that you're probably going to be 35 to 45% probability of win rate. And you need to understand and factor that in going forward. So we kind of look at it as you need to have your average wins be that much larger than your average losses. So we kind of like a general rule of thumb is we're always targeting 100% winners at the minimum. And then we're targeting hopefully having our stop loss around 35-40%. That way we can be right, 35% of the time, and we can still be profitable. 35 to 40% of the time we'll still be profitable, where others that are saying, well, I mean, I got a 50-60% win rate, but what they're doing is they're taking profits very early at 30%, 40%, and then they're getting hit on their losses sometimes at 50%. It's actually a losing strategy. So you may be even 50 or 60% win rate, but your P&L is not profitable. So that's kind of one of the things that we see that people do. They make a mistake. They focus on that win rate when they really should be focusing on the average of the win versus the average of the loss.
Oh yeah, I couldn't agree more. And on that topic, I did a portfolio analysis a few years ago, and this was in the second time that I was having my drawdown. My favorite strategy were iron condors, right? I'm familiar with that, right? Selling an out of the money put spread, selling an out of the money call spread. And the thought behind it was, hey, this has an 80% win rate. It's going to be great, right? But let's say, for example, you make $200 when you're right. That's the most you can make, but you could lose $800 every time you're wrong. So if you were wrong once and it was a full loser, it would take you 4 more full winners to make up for the one loss.
Exactly.
And that was exactly what happened in my portfolio. Like exactly what happened. It was an 80+% win rate, which sounds incredible, unbelievable, right? But yeah, it totally was. But the 20% of losers in that account accounted for 90% of my lost dollars, right? So I know that got real mathy there, but essentially all of my lost dollars come from my favorite strategy because I didn't know how to cut my losers, right? And keep the winners working for me.
Well, yeah, and especially when you're selling premium, you kind of, in that kind of strategy, either an iron condor, or if you're selling premium, spreads to the upside or put spreads to the downside, you need to focus on, how much premium you're collecting, and then you still need to be able to cut your losses because, like you said, if you take a total loss on that, and that's one of the big mistakes people don't make, they kind of sell these spreads a lot of times, especially when they first start out, and they don't set a stop loss on them. They kind of just say, well, it's kind of all or nothing. And that's actually, I think, the wrong way to do it. What you should do is you should focus on maybe trying to collect more premium on that trade. So you trade a little bit shorter, but then you set that stop loss at maybe double that premium so that, say you collected 20%, you're going to stop out at 40%, at minus 40%. So that way, you're not taking those 100% losses on that premium that you sold. That's kind of one thing that we've kind of looked at that's helped because we do also premium selling on top of long buying premium as well. So that's something that helps our strategy. Obviously, you start seeing a downturn like we saw in February, March, and you kind of start getting blown out of some of those trades. That's a good strategy to have. Is it reduces that risk because if you think about it, how many of those spreads would have went to zero in that situation?
Right. And so are you guys looking at like moving average crossovers or a moving average line in general as your exit point or your stop loss, or are you using it solely based on the price of the options? Because there's 2 different things there.
So that's a lot to unpack, actually. So we do things, obviously we try to, I like to keep things simple, but yet obviously when you're working the options market, it's still complex. So we do a lot of quantified, analysts work on certain securities and stocks. We'll see things differently. Like certain companies, certain stocks will react differently to moving averages, things like that. So for like buy signals, we'll notice that like maybe just for example, like this a gold miner stock, right? It really likes to follow that 80-day moving average, which is an odd moving average. People aren't really having their eyes on this thing. And for some reason, we look at it, we can pull like the last 10 signals, 7 of those last 10 signals, 70% of the time it has bounced there. That's giving us a trading signal. Now, for exit strategies, what we're trying to do is we're trying to identify areas of potential resistance. And then once we get up to that potential resistance area, we like to de-risk a trade as well at that point. So what we'll do a lot of times to our subscribers, we'll say, you know what, it's achieved 100% target or 200% target, whatever we're doing, depending on how risky the trade is. Take half of it off here, right? And then as a trader, we'll usually a lot of us will look at like, a 5 or 10 day, depending on time though as well. If it's short-term expiration, yeah, like a 5 or 10 day, it breaks that, we're probably out of the trade, right? Because there's a chance that it pulls back enough. If we still have months left on the trade, we may give it some slack, right, to run back, especially if it's on the long premium side, buying premium side of the trade. We'll maybe give it some slack, even let it run down to like a 40 or 50 day and see if, there's another potential leg higher. Maybe it's just consolidating, putting in like, as technical analysts, myself, a bull flag or, a wedge type pattern. And it's just really just waiting for that next leg higher. So that's kind of how we look at it, but we do look at it as we want to de-risk that trade, especially if we hit the initial targets. And then, we can see if we can let convexity run, really, is what we like to say in the office and on the trading floors, is let that run, because as that delta has approached, 90 to 100 at that point, every dollar move in that stock is that much more powerful on those contracts now.
Mm-hmm. Yeah, that makes a lot of sense. So Matt, what other mistakes did you want to bring up today? Because this has been a good conversation. I like this.
All right. Now the next part of the allocation common mistake that we kind of see is position sizing, right? So being in the options market, you're kind of in this fixed fractional bet system. And like I said, you're kind of you want to let the power of convexity kind of work for you in a trade. You're letting it run. You're kind of doing the same thing when you're setting up your position sizing as well, right? So you start looking at, you've already allocated, you said, hey, okay, I'm comfortable with 20% of my portfolio in options. I'm going to do a little stock trading on the side. I got, like you said, maybe you're more all-weather type of strategy outside of that. So you got some stocks, you got some, fixed income investments, some gold, things like that, more riskless or less risky, maybe some preferred shares. But you're looking at that 20%, you're saying, how do I want to allocate these positions now? And we never recommend really anything more than 10% in an option type position. And really, I think that's more for like the conservative type trades. So either deeper in the money type trades, maybe like you said, put sells, or not really put sells, but maybe spreads more like it, or condors. And then as you get riskier, so shorter term expiration, closer to at the money, maybe slightly out the money type options, you're going to really want to downsize that allocation. You don't want to be spreading 5 or 10% allocation to an out of the money option. You might want to have 5% or 2% even, because as you're having that lower, paying that lower price, you're actually increasing your leverage ratio. So when you're increasing that leverage ratio, though, the chances are you're going to have obviously some options, and you're taking on extra risk that they're going to expire worthless. That's just the nature of this game. So you want to allocate less to those so that you can still stay in that game and keep going forward. The other thing you kind of want to just do there, then I guess you would say, is spread that out and look at it from your longer term perspective, as we were talking about before, shorter term perspective, and maybe take 5 of those positions, put them in the money, kind of longer term type strategies. Then you take that other half of that portfolio that you've allocated towards options, put them in riskier type trades, at the money, out of the money, spread the wealth, diversify again, and that way you kind of just stay in this game.
Listen, Matt, there's just entirely too much to learn to trading. I don't get it, man. No, I'm joking. But what I mean by that is, there's lots of resources and people out there that are looking to help where they can. And that's one of the things that Schaeffer's is they're one of those resources where they can help you learn how to trade and really give you some leg ups that you may not know otherwise. And then they've got smart people like Matt, like he just went into that deep dive there. He's thinking all these thoughts, so you don't have to.
I've written a short guide on how you can use the triple stock profit system. It's the secret weapon every investor needs right now to change your financial future. And you can get it for free by visiting triplestockprofits.com or in the links below. Also, if you want to join a community of traders just like you can get free access to the elite membership that has even more resources to help you trade faster and trade smarter.
So, Matt, tell me where people can learn more about you and Schaeffer's investment research.
So you can learn more about us at schaeffersresearch.com, and myself, you can find me on Twitter at mtimpane. You can also find us at Schaeffer's on Twitter as well. We're putting out great content. We, on a daily basis, we put news out there. So we're doing market recaps intraday, and at the end of the day, we're also talking about unique option activity that we see that's going on in the markets. Myself and some of the other traders that are on the floor will be putting out levels that we see within the broader market, or certain securities as well on our Twitter handles. And then if you want to learn more about what we do, our strategies and things, you can give us a call. You can visit the website. We do have all of our trading services up there as well for people that are interested.
Well, there you go. And I certainly recommend you guys go in and check out Schaeffer's Investment Research. This has been a real pleasure. This is the second time I've had you on, Matt, and I definitely want to make sure that I can get you on again in the future.
Wonderful. Anytime.
It is great to be able to talk with somebody and in conversational format, just get as deep as we can, right? Because it's not like a lecture at a university. It's not like an online course. It's really just two people having a conversation. But because you and I are so familiar with the topic, it comes naturally and easily. And I hope that the audience out there can really pick that up and continue to come back, because guests like Matt coming on is a real pleasure to have on. So thank you so much for your time today, Matt.
Well, thank you for having me on. I enjoy it.
Yeah, absolutely. And thank you guys for tuning in to today's How to Trade Stocks Options podcast. Make sure you like and subscribe and enable notifications. That way you never miss whenever we have guests just like Matt on, and more tools, tips, and tricks to help you trade faster and trade smarter. And I'll see you on the next episode.